Thanks for joining us this week. I'm Scott Inman. The older I get, the more I appreciate and value my time. Time is our most valuable resource. You can't make any more of it, but you can certainly waste it. And time is possibly the most valuable thing you've got too when it comes to investing. If you watch the news, there is great worry about the economy and the stock market. Will we enter a recession? How bad will it be? Have we seen the worst of the stock market downturn, or could we reach a new bottom? And we talk about these concerns too in our weekly segment. But if we enter a recession next year, it will likely be a short-term problem. If the market drops to a new bottom, it is likely a short-term problem. For those of you watching the video version of the Fastest Four, we have two charts this week that drive those points home. The first shows the return of the S&P 500 index from 1996 through the end of September of this year. Check out the trend line that begins in March of 2009. That was the low of the Great Recession, and since then we've been on a tear, at least until February of 2020. That was the beginning of the economic shutdown from the COVID-19 pandemic. The abrupt stop in the economy caused a 34% drop in the S&P 500 in a matter of weeks. After that, though, we took off again, roaring to new highs in 2021. If you just focused on what's happened to your stock investments since January, it would be easy to panic. We were down 25% in the first 9 months of the year. But look at the chart. You could make a case that we've simply returned to the trend line. Our trajectory from pre-pandemic to right now is on the same path we were on. Now let's take a look at the second chart. And this makes our point that equities should always be considered long-term investments. This chart shows the rolling returns of the S&P 500 over the past 50 years for durations of 1 year, 5 years, 10 years, 15, 20, 25, and 30 years. You can see in a single year, the index has returned anywhere from 53.7% to negative 44.8%. The range, though, gets smaller the longer out you go. And take a look at 15 years. Over a 15-year time frame, the S&P 500 has never been negative. Of course, that's not a guarantee about future returns, but it is a proven track record that it's about time in the market, not timing the market. Now, if you're younger, it may be easier to accept this. You may be investing for retirement that is decades away. A near-term retiree may struggle with this because, as new clients have often expressed to us, they don't feel like they have that kind of time for the market to recover. That's where planning can make all the difference. Retirement may be the finish line of your work life, but it is not the finish line for your investments. If you build a plan that includes a diversified portfolio and a segmented approach that utilizes more conservative investments for income in the first decade of retirement and doesn't plan to sell the equity investments for 15 years, you still have time. And when it comes to investing, just like life, it's all about time. Thanks for listening.